Okay, great. Thank you. Okay, so good morning, everyone. So first, I would like to thank the program committee for including my paper in this wonderful conference. So the title of my paper is When Financial Innovation Backfires, the Effects of Credit Default Swap on Corporate Environmental and Social Responsibility. So basically, I just focus on the impacts of the financial innovation, which is the CDS. So CDS will be relatively a new financial instrument compared to the traditional ones. That was invented in 1994 and began to be very famous during the subprime financial crisis. So actually, this kind of things was invented by this woman, which is Blake Master. So I just use this very simple case to show you the general structure of CDS. So it's the original idea of the CDS. It just come within this case, try to solve the problem of the ExxonMobil. So ExxonMobil actually that there will be some kind of disaster caused by this company due to the oil spills. So in order to solve those kind of problem, they need the money. So they reached the JP Morgan and try to borrow the money. For JP Morgan, they just worry that maybe there is a probability of default for the ExxonMobil. So that's why they create the CDS. So basically what JP Morgan did is they just approached the Euro banks, the EBRD, and they have an agreement. So based on this agreement, actually, so the JP Morgan will pay the periodic premium to the EBRD. It's sounds like we just buy some insurance. So if nothing happens to ExxonMobil, so the JP Morgan will continually to pay to the EBRD until the end of this contract. Well, if something bad happens to the ExxonMobil, for example, if ExxonMobil default, so that will trigger the payments. So in return, EBRD will pay the loss given default to JP Morgan. So here, this will be the first CDS contract. So we call the JP Morgan as a CDS buyer and the EBRD as a CDS seller. Well, for the ExxonMobil, that will be the reference entity. So that means the CDS buyer and CDS seller, they are just betting on the default for the reference firms. So it's that'll be the basic structure of the CDS. So actually, we have a very big most of the reference entity will be the bond. So the fixed income market pretty big, and there's at that time, even nowadays, there will be very limited financial instruments to transfer the credit risk for one party. So CDS will be the best one. So that's why it's just the market booms very fast. And also there will be some kind of criticism about the CDS. For example, this will be the size of the CDS. So after subprime financial crisis, actually the size of CDS market just reduced. But if you look at the total size, the total amount of their notional principles, so it's still pretty big. So it's around $8 trillion. If you look at the notional principle with the central counterparties traded in the CTP, it's still above 6 trillion. It's not a small market for sure, although it will be relatively smaller before the 2008. So there will be lots of studies try to examine the impacts of these financial innovations on the equity market, the bond market, the corporate behavior, such as the price discovery, the equity options, cash holdings, even along the supply chains, and also what's the impact on the CDS on bond market and stock price crashes, or even institutional ownership, corporate innovations, and corporate debt choice. So based on those literatures, due to time limits, I'm not going to elaborate all of them. So based on these literatures, actually we do find the CDS have significant impacts on the financial market and also the corporate behavior. But so far, there's no paper to examine how the CDS affects the corporate social responsibility. Well, in these stories, we just try to address these issues. Since for the CDS, they are betting on the default risk, so it's more like the negative side. So that's why we decided to tackle this question by examining the CDS tradings on the corporate, environmental, and social responsibility. Means what be the downside of the CSR. So that'll be the idea, that'll be our motivations. So in theory, we just borrow the theory from the CDS literature and try to examine the impacts. So the first is just based on the empty creditor theory. So the inception of CDS trading, actually, it will just provide the insurance to the bondholders. So for the bondholders, they are the creditor. They will monitor the firm closely, especially for the banks. They just want to make sure that they can get their money back because they cannot enjoy the upward potential if the firm is doing good, but they have to suffer from the losses if the firm is doing bad. Okay, so that'll be their payoff. So the presence of CDS actually will provide the protection for those kind of bondholders. So if the bondholder is protected, they will have a lower incentive to monitor. Okay, so that's called lower credit monitoring incentive. So if the bondholder monitor the firm less intensive, so that will increase the corporate risk taking because it will give the manager more flexibility to take the risky project. For the managers, they just have the incentive to increase the anticipated value of the firm because the active value can be considered as a call option for the firm. Okay, so if they increase the risk taking by increase the volatility of the asset value, so that will increase anticipated equity value. So the presence of CDS trading will lower the credit monitoring and results in a high risk taking. So that will rule out the low risk, especially for those kind of long-term or socially responsible projects. So from this win, actually, it will just it will just increase the likelihood to suffer from more CSR responsibility. And in the other channel, so for the CDS, since for the bondholder, they are protected. Okay. So let's say if the firm is just approaching the default, there will be some kind of negotiation between the debt holder and the shareholder. Okay. For the bondholder, they don't, if they buy the CDS, so they don't worry about the default because if a firm defaults, like the structure I showed on the previous slides, so they will get the loss given default. So they are protected. So in this case, they will be more tougher in those kind of negotiation with the shareholder. So we call it tough credit problem. So in this case, maybe the bondholder have some kind of incentive just push the firm to default. So for the manager, they know that the bondholder will do that. So they will just to be more conservative. So in order to avoid the negotiation with the debt holder, so the firm might choose to hold more cash that will be found in the literature, and they might focus on the short-term projects. So that will result into the underinvestment problem, especially underinvestment in the long term, such as the E and S project. So if you invest less resources in E and S, so that might result in a higher likelihood to suffer from the more incidents or more responsibility. So the third channel is more like the financial leverage. So if the bondholder can buy the CDS to protect themselves from the default risk, so this will just enhance, will just increase the lender basis. Because if you're the lender, you worry about the firm's default, you can buy the CDS. Okay, so in that case, so that will just increase the lender basis and make the firm to be much easier to get the financial capital. So that will increase the financial leverage. So if the financial leverage is higher, so in order to maintain, to serve the debt, so for the manager, they have to maintain the financial liquidity by holding more cash. So that will squeeze out the long-term CSR project. So all those three channels will point to the direction that the introduction of the CDS trading is positively associated with the reference firm's E and S irresponsible performance. Well, there's also voice from the other side. So as I mentioned before, so the presence of CDS trading will lower the credit monitoring. So that will give the manager more flexibility to invest. For the managers, they can choose to invest into the risky projects. Also, they have the flexibility to invest in the long-term projects. Why this is the case? Because usually for a CDS contract, the most popular case will be 5 years. or we also have the 10 years or 15 years or even 30 years. So that means, okay, for the managers, maybe they do not need to worry about the very short term. I'm talking about maybe 1 year or 2 year, or they just maybe just try to do some kind of long-term plans if they really want to invest or keen on the CSR. Okay, so the presence of CDS trading will give the manager those kind of flexibility. They can choose to do more risk taking. They can also choose to do some kind of long-term investment to boost the CSR of the firm. So it depends on the manager. Well, the second channel is, since the presence of CDS trading will just provide the protection to the bondholders, that will increase the creditor's risk tolerance. So the increase of risk tolerance, as I mentioned, so that will just increase the lender basis, increase the credit supply to the firm. So that means the firm might be able to get more financial capitals and to support their long-term CSR projects. So both those channels, actually, they point to the opposite way. So the introduction of CDS trading may be negatively associated with the reference firm's E and S irresponsible performance. So here we can see that, okay, in theory, we can get either positive or negative, so we need to let the data to tell us. So here we just collect the data, try to measure the corporate E and S responsibility. So we call it CSIR measures. So basically, we just got the data from the rep risk. So rep risk is just collect the incidence of E, S, and G. We only focus on E and S. It's just the rep risk actually identify and label the environmental and social issues. So we just look at all the issues related to environmental and socials. For example, like the environmental, the most well-known, the climate change, the local pollutions, the impact on landscape, and so on. Well, for the socials, there are human rights, impacts on the community, and so on. So here, they just identify the number of the incidents, the severity, means what would be the real impacts of those kind of events, and the average reach, and also the novelty. The novelty means whether this news is published for the first time or the second time. Okay, so if this is the first time, it will generate a stronger impact. So here we can see that we got some kind of volume. We also got some kind of measure to measure the real impact. So based on those data, we create two measures. The first one is just simply counts the number of the incidents. So we call ESI volume. So we just count the number of the issues or number of the incidents that related to the environmental and number of incidents related to the social, and then take the log. And the second measure will be the impacts. So we just use the severity times the novelty times the reach, try to measure the integrated impacts of a typical incidents on some kind of on the economy. So here we just aggregate them together, so we call ESI impacts. So we just try to measure the corporate social irresponsible behavior using those two measures, ESI volume and ESI impacts. That'll be the key dependent variable in our regressions. Okay, so this will be the summary statistics for those two measures. And well, regarding to the CDS, we just got the CDS data by combining a couple of data sets. So like the market, so this will be provide the quality data. We also have the GFI data, so that will be much earlier. We combine them together, try to have a full set of the CDS just in the US, okay? So here we can see that before, most of CDS was introduced before 2007. After 2007, we got a relatively small number of the new CDS, but there are still a significant number of the existing CDS contracts. So here, that'll be the summary statistics for the key dependents and control variables. So we control for the form characteristics, or we even control for the options, because the options will be another financial innovations in the recent decades. So this is also important. So to isolate the impacts of CDS, we control the impacts of the option active, the option trading as well. So here, this will be the key results or the key findings in our paper. So basically, we just find that there is a positive relationship between the CDS active. The CDS active is a dummy. This is indicator that's equal to 1 after the introduction of CDS trading. And so here, if you look at the magnitude in our baseline models, okay, so we found that the total number of ENS incidents increased about 13.6%. And the aggregated impacts of ENS incidents increased about 20.5% after inception of CDS trading. So here we can see that it's not a trivial number, okay? So this might support the channel present before, so later on we are going to do the further analysis to pin down the channels. And here we also do some kind of robustness analysis due to time limit. I'm not going to elaborate them. So here we also look at the dynamic impacts before and after the CDS trading. So here we can see that the CDS actually will generate very immediate impact. So here the impact of the number of the ENS incidents increase 1 year, starting to increase 1 year after the introduction of CDS trading. We also have a figure to show it that will be more obvious, okay? So we look at the ES incidents amount and ENS incidents impact. Here we can see that, so after the inception of the CDS trading, so we do see significant increase. And we also do some kind of robustness analysis by using alternative ES measures. Maybe you worry that for the incidents, maybe it will be in a different industry, so they got the different numbers. So we just use the mean, we just use the number of the incidents minus the industry average, and also we also try the ESI dummy, and also we got the ES concern from KLD data set and try to do those kind of robustness analysis. It's not only rely on one single database. We do find very consistent results. We also try the number of CDS calls, try to measure the liquidity. We find that if the CDS market will be more liquid, so here the impact become to be stronger. And we also try other kind of measures. So let me just go through quickly because I still have a couple of minutes. So here we also try the PSM, and we also try the IV approach, okay? And to show those kind of causality. So this will be very standard because as I showed on the previous slides, there will be a lot of literatures in the CDS. So we just follow the literatures to do those kind of independent analysis to show the causality. Okay, so let me just show you quickly about the mechanism, okay? So as I mentioned before, so there might be 3 possible channels. So in order to examine those channels one by one, so we just collect some additional data. The first one is just responsible creditors and shareholders. So if you want to examine the credit monitoring, so if there's a more responsible creditors in the firm, after inception of CDS trading, we expect the impact will be stronger because the monitoring incentive for the responsible creditors will be lower. So here, that's exactly what we found. That's verified the credit monitoring channel. And there's another interesting finding is about the responsible shareholders. For the responsible shareholders, actually, they will be affected by the CDS trading as well. You know, if the responsible creditors stepping out after inception of CDS trading, so maybe the responsible shareholders, they will just step in and they try to fill the gaps. And here we do find that the presence of the responsible shareholders, we just use the signature of the PRI. We found that will elevate the impact of CDS trading on the CSR. Okay, so that means the responsible shareholders, they do able to fill the gap of the empty creditors after the introduction of CDS trading. And then we also look at some kind of debt dependence and also the bond lenders. So if the firm more depend on the debt, so the creditor becomes to be more important. And for the bank, if they got bank lenders, because the bank have the capability to monitor the firms, so after the introduction of CDS trading, that would generate a much stronger shocks in order, for the reducing the credit monitoring, we do document the stronger impacts that supports the credit monitoring channel. And for debt negotiation, it's more like the top creditor channels. We just use the debt default probability and cash flow volatility. So if the default probability is higher, so that means when the firm is more closely to the default, so the top credit problem become to be more pronounced. because there's a higher likelihood to involve into those kind of negotiation. So here we do document significantly more stronger impacts. So for the CDS on the CSIR. So that also supports the top creditor channels. And then we also look at the impacts of E and S. So if the firm has some kind of good ES performance, so we do find that the CDS impact become to be much stronger. And we still look at, then we break down the ENS into a different category and try to see that, so what's the impact of CDS on typical issues? So basically we found that the CDS will affect the climate change, the pollution, the human rights, and also the forced labors, okay? And lastly, I just quick conclude. So in this paper, actually the key takeaway that we just show there's a significant positive relationship between the inception of CDS trading and corporate ENS irresponsible incidents. So we just do the analysis to show that the empty credit problems, especially the lower credit monitoring and also the top creditors, actually there's play some kind of roles and to explain the positive relationship between the CDS trading and ENS responsibility. So that's all for my presentation, and thanks very much for your attention and welcome for the comments.